One of the problems with recruiting for investment banking is not the knowledge or skills you acquire, but the access to talk with real investment bankers to put your best foot forward. Our sponsor, WSO Academy, can provide those connections with 60 head mentors who are finance professionals at top firms like Goldman, Centerview, and JP Morgan. Imagine being able to get on the phone within 24 hours with one of the Academy's 1,300 mentors right before a critical interview. Get on the waitlist for WSO Academy today by clicking the link in the show notes or by visiting wallstreetoasis.com/academy. All right. Welcome to the Investment Banking Insights podcast. My name is Alex Mason and I am your host. Thank you for joining me. I am so grateful that you're here because, man, you're investing in yourself, your skills, your knowledge, and I'm just so excited to share with you today these accounting type questions. In the first 23 episodes of this podcast, I can't believe we're already at episode 24. We've just been cranking these out. We have talked about an overview of the investment banking industry, things you should know about the recruiting process. And then we spent a good number of episodes, over a dozen episodes now, talking about fundamentals about the financial statements, what they mean, what the terms are, how they connect together. And boy, we are just building and building. And today we're going to be talking about the famous interview question, walk me through the three financial statements. It's a basic level question. Everyone interviewing for investment banking should be able to answer this one. And I'm going to tell you how I think about it here. So someone says, walk me through the three financial statements. What are they trying to assess here? Well, from my viewpoint, the purpose I think they're getting at is just assessing your understanding of what the financial statements are and how they function. And we've already covered this on previous episodes. So if you've been listening, it should be pretty easy to answer this question. Let's go ahead and go through it. The income statement. What does the income statement do? Well, in the income statement, you have your revenue, you have your expenses, and ultimately you have your profitability. You start with revenue at the top, you end up with net income as a result at the bottom. This is considered the firm's profit. Then you have the balance sheet. The balance sheet shows you the company's assets, the company's liabilities, and the equity in the corporation. What the company owns versus what the company owes. Now, assets are what the firm owns, liabilities are what the firm owes, and equity is what is left over. There are short-term and long-term assets and liabilities, and when someone talks about a short-term asset or liability, they're talking about something that can be converted to cash or is owed within the next 12-month period. So that's the balance sheet. The cash flow statement, you have three sections, but ultimately the purpose of the cash flow statement is to show you the movement of cash in and out of the company. So you have operating cash, investing cash, and financing cash flows. So you start with your net income at the top, then you make adjustments for non-cash expenses and working capital. And then at the end, you have the total change in cash. Now, some examples of non-cash expenses, these could be things like stock-based compensation or depreciation, which we talked about a little bit. We're going to be getting into depreciation a little bit more. And then an example of working capital changes, that's if a company takes on, for example, short-term debt. So the balance sheet wouldn't change because your current assets increase by the same amount as your current liabilities, the debt, but your cash flow would increase because you're raising capital. Okay, that was a little bit too long probably on the cash flow statement part of the answer. But fundamentally, let me just summarize this again in a way that I would actually respond to it if someone asked me this question in an interview. I would say, okay, the income statement tells you your profitability, your profit and loss of the corporation, your revenue minus your expenses equals your profit. Your balance sheet tells you your assets, your liabilities, and your equity, what the corporation owns versus what it owes. Your cash flow statement tells you the actual movement of cash into and out of the corporation over a certain period of time, both operating level, investing type cash, and financing cash flows. Boom, done. That's the answer. That's how I would actually answer it. All these little details that I added in at the beginning, I would try to limit myself to not go too deep into that unless someone asked me about it, because If you open yourself up to rambling or over explaining, that's a bad thing. And that's just a general interview principle. Try not to ramble a little bit because they can drill you on those little things that you say. So keep it high level, keep it structured. And those are the 3 financial statements and a summary of them. So we're just going to keep it short and sweet here. That's how I think that the question should be answered, in my opinion. And if you want to understand at a deeper level any of those financial statements, go back and check out some of the other early episodes. But next time, we're going to be talking about the question about some of the major line items on the financial statements, because it's not enough to just know what the financial statements do. We have to understand the components of them. So we're going to be talking about that in the next episode. This is Investment Banking Insights. I am Alex Mason, your host, and I'll see you next time.